Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Gale Bowman of IrishAngels. Gale, thank you for joining us.
Thanks, Paul. Happy to be here.
So what was your background before investing in early stage companies? What did you do before this?
Sure. I studied marketing in undergrad at Notre Dame and then went into market research consulting with Nielsen. Was there for a number of years and wanted to try a smaller company on the tech side. So I joined Orbitz.com and worked in their strategy and analytics group, which allowed me to see a cross-functional view of business. So from there, I really wanted to try my hand at startups. So I started a business while I was at Orbitz on nights and weekends that ultimately failed, but knew I really liked startups. And so I went back to business school and focused 100% on the startup world and ecosystem. And while in business school, started another company that did also ultimately fail. And as I was leaving business school, had the opportunity to start IrishAngels. So IrishAngels is actually my third startup.
Great. Well, tell us a little bit more about IrishAngels. Just what's it all about there?
Sure. We were formed in 2012 as an angel investment network affiliated with the University of Notre Dame. So this means that all of our investors, or most of our investors, have a tie to the university. So over time, we have built up our membership base to today where we have 230 investors that are part of our active network. And we focus on seed stage investing. So we'll look at companies that are raising rounds of $1 to $3 million. We do everything that a venture firm does in terms of going out to find the deals. Our team, which is our staff, we screen the deals, do due diligence, negotiate terms if needed. And then after the investment is closed, we work with the portfolio company CEO on an ongoing basis to make sure that our organization is providing valuable help to that entrepreneur and their company as they continue to grow.
That's great. So you see a lot of investors coming through making investments in startups. What's your advice for those who are just starting investing in early stage companies today?
Let's see, I have a lot of advice. So I've learned quite a bit over the last 7 years in this role. And I think the most important thing to remember with angel investing or seed stage investing is that you really want to have a good strategy, even as an individual. So you might do individual investing yourself, you might do it through a group, or you might be an LP in a fund where you're more passive. And you really want to identify how active do you want to be? Because if you're doing it individually, that's the most active and hands-on, and you really have to know what you're doing. And then an angel group will provide some assistance in terms of leveraging the collective knowledge of that group to make better decisions. And then obviously a fund is where you're entrusting your investment dollars to be placed into companies through a team that you believe has a strategy that aligns with your goals. So that strategy is really one that is critical when thinking about this asset class. Some other things to consider with the asset class is the rule of thumb that I share with individual angels is you really don't want more than 10% of your investable assets in the class. And so for myself, I think about building an angel portfolio of at least 15 deals over a period of 3 to 5 years. And based on where I am in my trajectory of my career, and I think about what kind of capital can I put to this asset class right now, I try to make 3 investments a year at the $10,000 level through the angel network. So if I think about a 5-year period of doing that type of investment, I will end up with 15 deals. And that's really what I believe is the minimum number of individual investments if an individual is building their own portfolio that's required in order to see portfolio style returns. And in portfolio style returns, we would expect half to go to zero, a number to return somewhere between 1 and 3x. And you're really looking for those 2 or so companies to really return quite a lot, such that pays out the entire portfolio, with the goal being to hit at least a 3x cash on cash return. So that's the general formula that an angel investor should think about. So once you know what your particular strategy is and how much you want to deploy and into how many deals you want to deploy per year, you need to think about how you want to find the companies. So if you have a lot of deal flow yourself, you're a previous operator, or you have access to those circles, you might do individual investing where you can help on a one-on-one basis. Joining an angel network is a really great opportunity for those that do want some assistance in deal sourcing. And so there are between 300 and 400 angel investment networks located across the country. that you can go to the Angel Capital Association and find one that is near you or that covers a topic that is interesting to you, as some are based on functional areas such as the life science angels. And then obviously a fund, if you want to be completely passive, is your last option that has its own challenges, but I don't think we're going to cover that one as much today.
Right. Well, that's good advice and a lot to think about for the investor who comes into this. And it is not an easy thing to do, is to invest in seed companies. But you've seen this industry evolve over the years. Where do you see the industry going, and what changes do you see in investing in seed companies today?
Yeah, over the last several years, we've seen rounds getting bigger, valuations getting higher, and we've also seen some movement from really big players. So these are large financing firms kind of coming down to look at A, B, and C rounds, so earlier than where they used to play. And what that has done is cause a shift in terms of which investors are looking at which asset classes. So with seed, I still think there's quite a lot of opportunity because the folks haven't come down into the really early stage levels yet, but that could happen in the future. You do see scout funds now from some of the big funds that will put $50,000 or $100,000 into firms really early on so that they have an option to invest in an A round. And we're seeing tons and tons of competition at the A and B round because many firms want to focus at that stage of venture. So right now, seed hasn't seen that, but it could. That's one trend that we may see. I do believe that we'll continue to see some shift in valuation. So if the economy remains strong, it might continue to tick up. At some point, hopefully it normalizes and comes back down because valuation is something that really needs to be at the appropriate level to reduce risk, not just for investors, but for entrepreneurs as well. But if you look since 2011, that line has steadily been climbing upwards.
Well, that's great. So what's your investment thesis for the early stage company? I'm sure there's many, but what would you say the IrishAngels investment thesis is in general?
Yeah, we look for three things. One is markets that are $1 billion plus. The second is that there's some indications of product market fit. And typically that's going to be in early revenues, but it could be in signed contracts that haven't necessarily paid out yet. It might be in partnerships that are signed. It might be that it's a pre-product company, so they're still working on the product, but we have done enough due diligence to really believe that they're building something that the customers truly need and will pay for. So there's lots of ways to get to that, but we do look to make sure that there is that initial early indication of product market fit. And the last thing, which I would argue is probably the most important, is regarding the team. We look for teams that are passionate about what they're doing and building, have a really deep and clear understanding of the market and the drivers and assumptions within that market and within their particular business that are going to drive it forward. And we also make sure that those founders can execute on what they want to do. So they might have a beautiful strategy for product and for marketing and for business development, and they know what they want their business to look like in a couple of years, but they need to be able to show us that they have what it takes to execute and move the ball down the field. So when we talk with the founders, we spend a lot of time really understanding why they're starting the business. We'll ask a lot of questions around the due diligence materials that we receive and have that back and forth dialogue to make sure that we really can understand from the founder's perspective what he or she wants to do with the business. Because at the end of the day, we're investing in the founder's vision. It's not about how we would run the company. It's about us believing in their vision and their plan of attack in terms of how they're going to execute. So I spend a lot of time during that due diligence process talking with the entrepreneur, the team, doing reference checks on the entrepreneur and the team, because we learn a lot of rich information from that is really critical to our thesis and making sure that founder is one that's going to be a true partner, and we really believe that they have what it takes to execute on their goals.
Well, that's great. So do you have a couple of portfolio examples, maybe one or two that fit that thesis that you can tell us about?
All right. Let's see. We have many, so I can share one. We led this deal within the last year. So we have a portfolio company called Ash and Erie, and this is a clothing company for shorter men. And so the two founders are fantastic. They got together because they saw this as a need in the marketplace. And we had gotten to know them several years ago and really like how they've been able to address different challenges that they've faced in the business. So we think that there's a lot of upside potential with this opportunity. And we were able to lead a seed round for them. And one of our investors sits on the board of their company. So that's an example of where we really believe that the founders are ones who can figure this out. Even though they don't necessarily have much of a background in the apparel business, they've been able to bring on people around them that can help them where they don't have that direct experience. But it's going to be their passion and their ability to execute that will help them to see this thing towards the growth path that it can.
Well, that's great. So what are the challenges in investing in early stage companies? Clearly, they are very new and so forth. But if you had to pick one or two, what do you think are the key challenges investors face?
I will answer this in this context. So there's lots of challenges. I think that early stage investing is really hard. It's a ton of fun, but it's also really challenging because you're making decisions based on a very, very limited information. And I think that's why you see a lot of firms that are getting excited about the A stage and later, because there's just so much more information there. But at the pre-seed and seed stage, there's just not a lot to go on except for that early data and what you think about the founder. So the real challenge that we have with early stage investing is making sure that it's a good opportunity, not just for those three things that I told you with the thesis, that it has a big market, product market fit, and a good team. The structure also has to make sense. And I think this is one of the biggest mistakes that founders make, is that they have created a structure within their company that precludes them from easily raising their next round of financing. And so I have a lot of conversations with founders about making sure that their cap table looks appropriate for the people involved at this stage of business in terms of equity ownerships, and the folks who do have equity stakes in the business are still working in the business and adding value, and that they're raising the right amount of money to hit the hurdles and milestones they need to get to the next level. And the price of the round, the valuation that they want or that they've been offered, is appropriate for this level. Because if they price it too high, which I see probably in 75% of cases where the entrepreneur wants to price it too high, or they've been offered a term sheet from a firm that has priced it too high, I have to counsel them and say, if you don't hit your milestones, next round, you're going to run into some friction between potential new investors and your current investors, because you would effectively have to do a down round. And nobody wants to do that. So it's my job as an early stage investor to make sure that you, the founder, are pricing this company appropriately today. And so this is a huge challenge that we have, because as VCs or angel investors, we see a lot of deals and we have pattern recognition across. But a founder only does this once, twice. The more experienced founders might do it 5 or 6 times max in their careers. And so we have to remember, as early stage investors, that it's not just our job to negotiate, it's our job to instruct and to make sure that we're sharing that information with the founders, because it can be a big challenge for them in the future and for us as investors too, because once we write that check, I see investment as now we're sitting on the same side of the table as the founder, and we're going to do everything in our power to help them be successful.
Well, that's good information. You see a lot of different deals and sectors coming through. If you had to pick 2 or 3 sectors that you think are really hot these days for investors to pursue, what do you think is at the top of the list?
Yeah, so we're sector agnostic. So I actually am not very well versed on sector specific items. I will preface what my answer is with that. But what I've been seeing a lot of is, I keep hearing future of work, and what does that look like? So a lot of firms in the past have said, we're an education technology company, we're a fintech company, we're a healthcare tech company, and they'll talk about their area of focus with a vertical. And now we're seeing firms really move towards an area of focus that's much more broad than one specific vertical. So like the future of work could be lots of different things, but it's all about technology that enhances either the organization or an employee's ability to do their job more effectively and more efficiently. And so that's one that I see a lot of. Enhanced computing is one that we see a lot of. And then we also see some trends as it relates to just millennial buying patterns. So the younger generations and how how they think about commerce. There are some trends there that are starting to inform different theses that VCs and angels have around what the next trends are for investment.
Well, great. Well, those sound like good opportunities. In the last few minutes that we have today, what else should we cover that we haven't?
I would say for these founders on the podcast, just to remember that if you raise money, you give up some control. And so I actually teach a class, and my personal opinion is that most entrepreneurs should not raise money, which is not typical maybe for an investor to say, but the founders who take money really have to believe they're on that fast growth path. And if they are, just knowing before they get onto that capital train, what things look like and what to expect. So talk to a lot of people that have done it and make sure that you understand. Read Brad Feld's book on venture deal terms, because just being informed about this and knowing what's coming is critical. And a lot of times founders will come in and they need to figure out a way to have friends and family fund them, but they should never take true angel or VC capital, for example. That's one thing to remember. The other thing to remember is there are ups and downs in entrepreneurship. And I suggest to everybody to give it at least 3 years if you're really passionate about it, because a lot of times it does take that long for a company to finally pop. So even though I say that we're seed stage investors, we're really early stage, a lot of the companies that we invest in have already been around for 2 to 3 years by the time that we talk to them. So the founder has bootstrapped it for a while, or maybe they had a friends and family around. So just remember that and don't get discouraged as you're on this path, because it takes a long time for everybody. There's really not a lot of overnight success. It takes a lot of that hard work over time. And for investors on the podcast, I will say that this is a really fun asset class. And I think we can make huge impacts as active angels in these early deals. Where I see angels adding the most value is when they're really passionate about the space, or they really believe in the founder, and they have the ability to help with something specific, whether it's sales strategy or process, or setting up the marketing lead engine, or financials, or fundraising, or whatever it is. Being able to provide that type of value to an entrepreneur at the early stage is really critical. But on the flip side of that, it's also important to remember that the founder is the one running the business. And I hear horror stories of angels that get really involved because they're excited, or it's their first couple of angel deals and they are overbearing for the founders. So just walking that fine line of being active, being helpful, and being available whenever the founder needs, but also not being overbearing, I think is, for a first-time angel investor, probably some of the better advice that I could provide.
Well, that's great advice. So how best for listeners to get back in touch with you?
Sure. We actually are about to launch a YouTube series. So this will be a short video series aimed at founders. Each episode will be about 3 minutes long, and it'll cover issues about company formation and financing, and then operations, and how to think about things like setting up a board and hiring team members, and how much do you compensate them, and all the kinds of things that founders tend to ask us that we realize, there's still not a lot of information out there. So that show is called VIA for Founders, VIA for Founders, and it'll be live on YouTube pretty soon. It'll also be on Spotify, Apple, Google, and SoundCloud via podcast. And then you can also find us on our website, IrishAngels.com, and then on our LinkedIn and Twitter.
Well, great. We'll add those to the show notes. I want to thank you for taking time to share your thoughts with us today, and hope to have you back for a follow-up soon.
Thanks, Paul. I appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.